All right. Good morning, everybody. Courtney here, Mass Mutual, Eastern Pennsylvania. It is a kind of dreary and gloomy, rainy Wednesday morning here in southeastern PA. And I am joined, as always, by my good friend and counterpart, Steve Parisi from IBC Global. Steve, good morning. Good.
Morning, my friend. How you doing?
I'm doing great.
All
Good to
right.
see you.
Likewise.
We're going to talk today about developing client solutions. We were having a conversation offline about a couple of things, and this topic arose. And I think it's a fairly typical situation for Steve and his group. Definitely a typical scenario for me. Steve, talk to me a little bit about a client comes to you. They have some goals in mind. They are some kind of educated on their own or through another advisor about product or about, some kind of aspect of financial planning. And they think they know what they want. Maybe it's kind of out off in the distance there. They don't know how to navigate and how to get there and what the building blocks are.
Yeah.
But they're giving you some kind of detail and some info. How do you start to pull all that together without, losing things or getting overwhelmed or the client getting overwhelmed?
Yeah, definitely. It's like one of my favorite things to do too. So I can give you an example and I'll explain how I really try to keep it organized for the client so they don't get lost and everything is presented clearly. They understand it. They have a couple options. We'll recommend the one that we think is best, but then let them choose the one they ultimately want to go. So to give you an example, someone recently reached out. He was 44 years old. He does research about personal finance and such. He knows a little bit about money, and he had an interest in whole life insurance for cash accumulation. Now, it was more than just the cash accumulation that he was interested in. So he's got a family, works hard, again, 44, so he's got about 20 years until his target retirement date. And he said, I'm interested in adding whole life insurance to my overall portfolio, my financial plan, and there's a couple reasons why. Cash value, I see the safety. This is a good, safe place to put money. Okay, everybody gets that. But what I'm really interested in is being able to use it for life purchases. One, I want to get a new car, right? Everybody likes cars, but he's interested in getting a new car and he wants to see how he could use the policy. Two, he wants to update his home. So that could mean he might want to build an addition down the road to move his parents in or something like that, because when they get older, he doesn't want to put them in a home. He wants them to be with him. And then three, also his kids' education. But all of that involves using the money before retirement. So when we put the plan together, what we're going to look at is A, how do we take that policy and really set it up where it's right for him, where he can fund it with the amount that he wants to, because he does have an idea of how much he wants to pay in, but he can fund it with the amount he wants to. Make sure it's flexible in terms of company selection. This way it never feels like a burden in case his cash flow dips or he loses his job or something like that. And then also, after the funding, how do we use the policy? And then phase three is how do we use it in retirement via tax-free income? It's a lot of info I just spilled on you. Does that make sense or is anything not clear?
Absolutely makes sense. Absolutely. Yeah. So talk through how that, began to develop and, what kind of obstacles or hurdles came up.
Yeah, definitely. So step one, where I always like to encourage people to start if whole life insurance is what they're interested in, is where this gets messed up, Mr. Client, is never with taking loans or taking income from it. It always has to do with how we start it. Like one of those things where if we don't get it right from the beginning, that's where people have buyer's remorse.
Yeah.
So he was educated. He had done a lot of research and he said, I know how much I want to pay in. Like I know what my cash flow looks like. What he said is my funding is going to be somewhere between 25 and 50 grand per year. I'm comfortable with that. However, I've also got this lump sum of about another $50,000. I want to throw that in the policy. So the first question I had is, okay, so if you want to fund, call it $50K per year, and then you've got a 50 grand lump sum, In the first year, do you want to start just with that lump sum and then build your bank account up again and fund it again? Or did you want to fund 50 over the course of the year plus the lump sum, which is technically a first year payment of 100 grand? Just to clarify that with the back and forth, small question, but very important when you look at the design. It's important to ask these questions, in my opinion. So he wanted to start with a 100K lump sum. So we looked at that, 100K lump sum, and then funding it somewhere between 25 and 50K per year. The ultimate plan that we put together was 100 in the first year and then 25K per year just through year 10. He could have gone through year 20, but he wants to heavily use the policy. So what we looked at is, because we're going to look at a home update probably 10 years from now, let's have the option where you can stop the funding altogether and then use the policy heavily to take loans and then take money you would have paid and dedicate those toward loan repayments, because that's important.
I was going to ask, how often are you in that kind of scenario, especially with, what you're calling lifestyle or lifetime purchases, or are you showing repayment of the loan?
Well, we always recommend it, especially if I'm using it during my working years. And the question I'll ask is, hey, if you want to fund it with the maximum of 50K per year and you want to use it for lifestyle, are you going to be funding 50K per year, taking loans, and then paying back on top of the 50K? Or do you feel like that might be a stretch?
Right.
Asking that is so important. I don't want to assume, oh yeah, you'll just pay it back too. Like, yeah, maybe they can, but if they can't, they're going to be stressed out. So we'll build the policy out where he could fund up to 50K per year. That's built in the plan, but we'll fund 25K, especially when he's taking loans, because now he's got extra cash flow to dedicate toward the loan. And then if he's taking big loans out and he wants to pay with more than 25K toward the loan each year, if we stop the funding early, it makes it very easy to do that. But when we build the plan out, we'll do it in a manner where he doesn't have to decide everything from day one, because life happens. So we can pivot as time goes. Anyway,
What kind of hurdles have typically come up at this point? I know that a lot of times your particular brand of client is very heavily self-educated, and the way that your marketing works, a lot of times these folks are coming in and they know what they want, but not always. So at this point in the conversation, when you're starting to build out the plan, what kind of problems are you running into? What kind of objections, or maybe not even objections, just things that require further clarification?
Yeah, definitely. So we don't get too many things that we need to clarify further, but the question that they have, what people want to see, is how do the loans work, right? That's what I'm always interested in too. So I'm like, all right, we're going to look at those in a second, but first, here's the funding. So the sample that we gravitated toward, 100K lump sum up front, 25K per year through year 10, the option to keep going. But here are the three most popular options, right? We've got a product with Mass Mutual, one with Guardian, and then another alternative. And then explain the flexibility features and really how he can use that policy. Because he said cash flow 25 to 50K per year. So mentioning small but important details, you've got these quality companies. What does your cash flow look like? If it fluctuates, Guardian might be a good option where your minimum premium is 5K per year. You can commit just to that and then add the rest at your discretion, like just throwing money in a bank account, extremely flexible there. Whereas Mass Mutual is great for the one-time per year payment, explaining just the different product nuances. So this way, once he's got it locked in and he's operating with it, he doesn't come back and say, oh, I didn't know this. This would have been really nice to know beforehand. That's like the worst thing you want to happen. So to answer your question, those are like the important parts we'll clarify in the beginning, just to make sure someone is set up with the product that's really best for them in their situation. And like how I like to progress through that when I'll provide a recommendation is the more information they give me, I look at it and say, okay, if that's me in their situation, here's what I'd probably like. I don't know, this might make me uncomfortable. I'm going to express that during the conversation or in the analysis we put together when we send it to them. This way they can see and hear that, because that's a lot of times what people are looking for. Like, what do you know? What do I know? What do I not know? What should I be asking? And if you provide those questions and answers for them, it helps them make a decision that they're confident about. They're not second guessing afterwards. Does that make
Along
sense?
those lines, yeah, along those lines, do you get a lot of, I would imagine that you do hear this a lot, folks who have goals and thoughts on how to execute and then want to know, do people do this? Do
Yeah.
other people do this? Do
Yeah.
you work on cases like this? I feel like that comes up a lot because, we solve at Mass Mutual. I work on a lot of business where folks are solving for supplemental retirement income.
Yeah.
And from an illustration perspective, when we're showing advisors and clients proposals, it'll usually look something like funding a policy, and then here's your maximum tax-free income from age 65 to 80.
Yep.
And I don't know a lot of people who get to age 65 and turn that spigot on and take that. It just doesn't, in real life, it doesn't work out that way. But
Yeah.
from an illustration perspective, it's a pretty picture. So are people usually wondering,
Yeah.
is this common? Is this common usage? I'm sure they want to see what you see or hear about what you see.
Yeah, so that question does come up a lot, particularly on the retirement piece. So I can hit on that, and then we'll loop back to using the policy, like buying the car and the home improvement.
Yep.
But in the retirement piece, what are people doing? Like typically, there's two approaches. They want to take income as soon as they retire, because you can take tax-free income from a life insurance policy, or they want to defer it. And a lot of times, like, they don't know exactly what they're going to need when they're 65. They might guess, but no, it's rare that someone knows, especially 20 years in advance, because life's going to happen. So what I've found to be helpful, showing what people like to see and what people do, is say, okay, here's what it looks like if your retirement date is 65. Here's what it looks like if you take income from 65 until the day you die. We're drawing down the life insurance policy. We do it conservative, so we don't have to worry about a lapse, but here's what it looks like. Here's what it looks like if you start at 70, and then here's what it looks like if you start at 75. You'll see the longer you defer it, the higher the amount is. So you've got that option. Also, what you can look at when you're taking income from a life insurance policy is what some people do is say, okay, at 65, I'm not going to touch the life insurance policy. I'm going to spend everything else down aggressively because I want to leave money to my beneficiaries, and leaving money through other assets is often taxed. Life insurance is not. So they'll spend everything else first and then leverage the life insurance cash value to take income from. And then when we die, we still have a sizable death benefit that's passed to the next generation. So if they're concerned about the next generation too, or that's important to them, you'll build that out in the plan. And you talk about it, and that's an example of what other people do. So again, you show the top 2 or 3 most popular strategies so they can see it, learn, and then say, okay, here's the strategy I think I want to execute down the road. When I say I think I want to execute, remember, we can pivot as time passes. So that's something they don't have to say, this is what I'm doing 20 years from now. It's like, yeah, you might, but things will probably change too. So we can change that without having to change how we set the policy up front. Does that make sense?
One last caveat to that, and then we can go back, is the most commonly talked about strategy at Mass Mutual with regards to retirement income is using the life insurance policy as what we call a buffer asset.
Yeah.
Where in years after, you're really heavily leaning on your qualified assets or your investment assets, your IRA, whatever that vehicle is, to provide annual retirement income. But in a year where the markets are down, that asset took a hit, using the life insurance policy that next year to provide supplemental retirement income and give your asset that's down, the qualified asset, a chance to rebound and get back as markets rebound. The actuarial science on the efficiency of that type of model is tremendous. And that's something that we talk about all the time.
Yeah, I like that. I've seen that model before, and it's quite nice. So I mean that's another option you could consider too. But that works well. Just when you're leveraging assets in the proper manner to take the income you want in retirement. That's really what you're
Most
doing.
efficient,
Yeah.
whatever's going to be most efficient at
Yeah.
that time. All right, so talk about the real life mechanics
Yeah.
of someone who says, I'm going to use this to buy a car, I'm going to use this to fund a business, whatever the purchase may be.
Yeah, definitely. So after we've got the funding and the product locked down, they want to use the money. So if he wants to buy a car, for example, first question is when. So 1 to 2 years after he starts the policy, he wants a new car now. Right? So what we would look at is, okay, if we use this policy to buy a car, how much does it cost? 50 grand, right? A nice new van for his family or a truck, depending what he wants. So he will model a $50,000 loan coming from the policy. What I'll always do is show here's what the policy looks like if you don't touch it, and then here's the 50K loan coming out. Do you want to pay it back? Yes. Okay. Do you know how much you want to pay it back with? I think 10 grand. Okay. Do you want to pay the interest in addition to that, or do you want the 10 grand to be applied toward the principal and interest? Asking those questions, right? And then helping them make the decision. That's important. Yeah. So in his case, he said 10 grand per year net. Have that go toward the interest, and then everything left over goes toward the principal. Okay, here's what it looks like. So you repay that loan. Takes you 6 years or so when you include the interest. But when it's paid back, what we'll look at is here's your cash value on that loan illustration, and here's your death benefit. Look at the illustration to the left because we'll put them side by side. What's your cash value and death benefit? They're the same or they're very similar. Check that out. The money kept on working. So people see that and they like that, the fact that it keeps on moving forward. And if they are a really analytical numbers person, they want to see, okay, like what was the true cost though? What we would do is just tally up the annual interest they paid, so the yearly interest, and see how much did you pay to the insurance company. And then at the same time, look at how much you earn from the insurance company, and then put them side by side to just answer the question, did I pay more than what I got? Total and on a yearly basis. In a case like that with a car loan, like you're going to come out ahead.
Yeah.
Yeah, early on, like if you're borrowing the first or second year, you will be in the red initially because the policy is going to have a negative return. But again, just showing that so people are aware, and then they don't feel like later, hey, I didn't quite know this. I just wish I would have seen it at the beginning. Like that's where problems come up. So if you can help people be aware of that and show how it really works and highlight the areas that sometimes our peers, and I used to be like this myself, don't want to show because you feel like it's a negative feature of the product. So you can just not show it. The person might be more excited and like you more and want to buy. It's like, no. Show that, because if you don't, that's going to make things worse. To feel like, why didn't you show me this? Are you trying to hide it? What's going on here? It's like, nope, let's be upfront, and it builds so much trust.
Well, to further that point, you're saying early on you're in the red. I mean, if you went to the dealership and bought the car and financed it,
Yeah.
or just paid cash, you're completely in the red.
Yeah.
There's no chance to recoup any of that.
Yeah, correct. And there's times we'll compare that too. If someone's trying to decide, should I use my policy? Should I use cash? Or should I finance through the dealership? That's the question. You'll lay them all out side by side. And with cash, like what I'd want to see is, okay, if I just buy it in cash, what's the lost opportunity cost? Because it's not an account earning interest. So I do lose interest, but at the same time, I get peace of mind because I don't have to worry about payments and it's done. Like debt free is always nice.
Yeah.
What happens if I finance it with the lender? What's the interest rate? I'm obligated to them. Does that cause any stress? Do I say, I just wish I could pay this thing off? But really, what's the total interest? And then if you finance it with a policy, what's the total interest? You've got the freedom to pay it however you want. You can even not pay it back. So does that flexibility make you feel a bit better?
Yeah.
So you're looking at the numbers, but also hitting on the emotional questions, because a lot of people, when they hear the word loan, even if it's a policy loan, because it's flexible, but it's a loan, like, I want to get rid of this. I don't like that. I want to get rid of this. So
I feel the same way. Yeah.
that's the thing. So if you feel like that, what we shouldn't do as an agent is fight you on, oh, you don't need to worry about it. No, you don't have to pay it back. This is how you should do it. Or if I come off it like that at all, you're going to be resistant to me. So it's like, okay, no, fully understand. You do have the flexibility where you don't have to pay it. But here's what it looks like if you do both. And if you want to clear it, here's the model so they can see it. Just so you know, you can do it however and whenever you want. Don't feel like you have to do it right away because you're not going to get any debt collectors. There's no pressure. It's a private contract. You've got the word loan in there, really, so you can take it tax-free.
So that kind of mentality, I think, is what is going to drive me. I'm thinking about this as a consumer with my policies. When I take a loan for a specific purpose, I want to pay it back. And that it's not negative stress. That stress in the back of my mind, it's like, pay that back, pay that back, pay that back. Otherwise, I would just overload everything and be out on the street.
Correct.
So it's not necessarily bad stress. Now it's different than somebody who doesn't fully understand the loan mechanics and hears the word loan and thinks they're uncomfortable with that. That's a different type of question.
Yeah, so there's the education piece there, and also just kind of going back to his plan. In his case, taking income is important to him in retirement. So if you have a loan outstanding on your policy and you want to start to take income, you're going to be able to take out less if your loans are paid off.
Yeah, the ideal scenario is all those any loans are cleared up by the time you get to that retirement timeline.
Correct. Correct. So when you build that plan out, the perfect plan is to have them repaid. And again, that's what he wants to do. But the fallback is, hey, what if life happens and I can't pay it back? Well, then here's how much you could take.
Right.
So that way he knows, okay, I'm not obligated to do that. I'm not going to be penalized or lose the policy if I don't, but I'll be able to get less if I don't repay it. So it's talking through that and then really tying everything in a bow and saying, here's our recommendation, here's what we would do, here's the implementation, and then, by the way, don't feel like you have to remember all of this because we do reach out to you every 6 months just to keep in touch and go through updates as needed.
Well, after the fact, you've built this plan and in conjunction with the client, I know that you guys are heavily involved when the client wants you to be in ongoing policy servicing and managing these loans and just helping the client with whatever they need. And I'm sure it really helps to have all that background information that you guys have from the case file.
Oh, yeah, big time. I mean, that's huge.
Constantly revisiting those conversations.
Yeah. I've got 2 of those today, just where like a lot of time's involved just in putting the plans together. These are for people that have had policies for years with us. One has several $1 million in cash value, something like that, and he wants to be able to use it for an investment he's looking at, but he wants to know, if I look at my cost to borrow compared to what this investment's going to yield, like what's the spread there? Dollars, I want to see. Percentages are great, but show me the net dollars. All right, here's what we'd look at. Then another had some big policies on the entire family, ran into some life issues, just where funding them aggressively has become difficult, where he had been he's not paying the premium. He said, hey, let me just pay it through loans for a while. I want to finance it and then pay the loans back later. But he's been doing that for a while now. I'm like, you know what? I don't know that I would keep doing that unless you are certain you're going to have a big lump sum and be able to pay them. What I might recommend is let's stop the premium payments, have them paid through dividends and interest, but then dedicate any of your resources toward the loan here. This way you can begin to repay them. So helping with that as time passes and just being able to look at it so you can prevent an issue from occurring down the road.
Well, and that last scenario that you just ran through, even if the client is savvy enough to come up with some options on their own or to analyze this on their own, they definitely need somebody who's living in this every day to walk them through the mechanics of whatever that solution looks like and provide some other options and show them what the positives and negatives are. I mean, it's critical that you guys are there for them after the fact.
Yeah, just help them out. I mean, that's the thing. If they want to do a certain thing, they're like, this is what I want to do, then we'll show them what that looks like. Then also show a recommendation. And then sometimes if someone says, what should I do? Here's what I would do. And we'll show them exactly what to do and then show them the steps to take. This way they can do it very easily, because it's a lot to track and manage on yourself. It's like when I get recommendations, right, from my tax attorney or CPA or any technical thing that I'm not involved in every day, I'm like, I don't know what to do, but I trust you guys, so tell me what I should do.
You don't know what to do, but you certainly wouldn't have even known how to build out whatever they put together to present to you.
Yeah, exactly. So, you do get a lot of folks like that too, which is perfectly fine because they've got other things going on in their life. And they're like, listen, I'm working with you because I want you to do that for me. I'm like, hey, no problem. We'll do that. But if they want the information, they want to see how the watch is built, then we'll show them how the watch is built.
Yeah. Awesome. Cool. Well, listen, everybody, I think you can tell, and if you know Steve and his team at all, you already know this, but these guys take a tremendous amount of care and diligence in building out plans for clients and working with their clients, not just up front during the sales process, but, really for life. These are lifelong plans, and these guys will support you and help you reach your goals. If you want to talk to Steve or his team about anything IBC related, please reach out to him. That's Steve Parisi. If you want to talk about Mass Mutual, life insurance, any kind of advanced planning concepts, my name is Mike Courtney, and we'll be back and talking to you again soon. Steve, thanks a lot.
Thanks so much for your time. I appreciate it.
See you, buddy.